Okay, so when I say the word stock market, what exactly pops into your head? Chances are you're picturing that classic, chaotic New York Stock Exchange trading floor. You know the one. Dozens of people packed shoulder to shoulder, frantically yelling out tickers, waving pieces of paper across the room. It's a high-stakes, intense environment. But here's the crazy part. While that used to be the only way to get in on the action, incredible leaps in technology have literally brought that exact same capability right into our living rooms. Now, everyday people can just pull up a chair at home, open a laptop, and try to make money in the markets. But there is a massive catch that we are going to unpack in this explainer today. Because what you're actually doing with your money from the comfort of that couch, well, it might be completely misunderstood.
You hear it all the time, right? People constantly use the words trading and investing interchangeably. You'll hear a buddy say they're trading stocks when they're actually investing for retirement, or someone brag that they're investing when they're really just day trading on an app. And you know, it makes total sense why it's confusing. Both involve stocks, both involve putting your hard-earned money in the market, and both are ultimate attempts to turn a profit. But the reality, these two terms represent vastly different approaches to your money. If you are aiming to grow your wealth, understanding exactly which side of this line you stand on is absolutely critical.
So here is the roadmap for today's explainer. First, we're going to look at the trading illusion. Then we'll break down timing, fast versus slow. Next is analysis, price versus value. After that, we'll uncover the high-risk reality. And finally, we will wrap it all up with the final verdict.
All right, let's dive right into part one, the trading illusion.
If we just look at the literal dictionary definitions, things start out pretty simple. Investing is just spending money hoping for a larger future return. Trading is simply the act of buying or selling investments. So technically speaking, there's no strict, hard and fast rules separating them. But out there in the real financial world, these two words represent completely opposed strategies for making money. It's like night and day.
Which brings us to our second point, timing, fast versus slow.
Okay, trading is fast, like incredibly fast. It is all about speed. Day traders will literally buy and sell a stock in the exact same day. Sometimes they hold it for minutes, sometimes just seconds. It's a rapid, volatile, relentless cycle. But investing? Well, investing is a whole different ballgame. It is slow. You place your money in a company because you're betting on their long-term profit growth. So you buy, and then you wait. 5, 10, maybe 30 years. You're relying on gradual, steady appreciation, and you are entirely ignoring all that chaotic day-to-day noise.
Moving on to part 3, analysis. Specifically, price versus value. To really wrap our heads around this difference, we kind of need to split a stock into two completely separate concepts. First, you have its current price. This is a literal, real-time reflection of buyers and sellers at any exact moment, and honestly, it's largely driven by human fear and greed. Second, you have its intrinsic value. This is the true, underlying fundamental worth of the company itself. Let's pause and focus on that concept for a second, because intrinsic value is incredibly hard to pin down. In theory, it is the true, objective worth of a stock that literally only an all-knowing, omniscient being could perfectly calculate. Over a long enough timeline, a stock's actual market price should track pretty closely to this intrinsic value as the company's real-world information becomes public. But because human emotions constantly get in the mix, the day-to-day price of a stock frequently deviates from this true worth. Now notice how differently the players in the financial world use this information. Passive investors, they completely ignore those short-term fluctuations. They just ride the broad growth of intrinsic value over decades. Active investors, on the other hand, play detective. They estimate intrinsic value, trying to find discounted stocks where the current price is lower than the true worth. But traders absolutely do not care about intrinsic value. In fact, many of them couldn't even tell you what the company actually does. Their sole focus, their only goal, is exploiting the wild volatility of the stock price itself.
Because they only care about that price tag, traders rely heavily on what are called technical indicators. Instead of reading a company's business model or quarterly reports, they are looking at historical pricing. They're searching the data for developing mathematical patterns. This is exactly where you get that classic image of a professional trader sitting in the dark, glued to 4 glowing computer screens, staring at complex graphs and charts, just to quickly exploit a trend. They jump on short-term news shifts, maybe buying a stock today just because tomorrow's press release might cause a sudden, temporary jump. They're dealing in fragmented little snippets of information, rather than developing any real understanding of the firm's actual operations.
All right, section 4, let's talk about the high-risk reality.
Come on, we've all seen the ads online, right?
Those flashy, over-the-top videos of newly minted millionaires stepping out of a sports car or off a private jet, claiming they went from zero to hero using some simple, foolproof $300 trading strategy. It makes the whole thing seem incredibly easy, like this alluring get-rich-quick field, but I'm here to tell you it is mostly an illusion. Actual trading requires an immense amount of time, stress, and effort. And the kicker? Many successful trades end up yielding only a tiny fraction of a percentage point in profit. To make an actual living doing this, traders have to continually roll massive amounts of money, sometimes even borrowing money just to leverage their returns. They are exposing themselves heavily to violent, unpredictable short-term volatility.
Look, if you're an amateur sitting on your couch trying to day trade, the odds are aggressively stacked against you. You are being forced into split-second decisions based on fragmented information. And who exactly are you competing against? You're going head-to-head with industry professionals who have access to massive institutional wealth, cutting-edge private research, and the absolute best algorithms in the world. These computer algorithms can execute a trade faster than you can even say the word stock. It is, quite simply, not a fair fight.
And that brings us to part 5, the final verdict.
Honestly, trading is a whole lot like playing poker. Does it involve skill? Absolutely. And yes, professionals really do make a full-time, highly salaried living doing it. But pure chance plays a massive, undeniable role. When you sit down at the trading table, you are essentially playing against pros with vastly more money, more data, and more experience than you. The odds are simply not in your favor. Because of this harsh reality, almost any sound financial advisor will tell you that long-term investing is the far superior path for the average person to actually capture real economic growth rather than trying to fight a frantic, exhausting daily battle.
Sure, patiently holding a boring index fund for 10 years is never going to give you that intense, adrenaline-pumping rush of executing a leveraged, high-frequency day trade. But hey, that is exactly the point. Because if you are really just looking for the rush of high-stakes gambling with not-so-great odds, you might as well just go to the casino. At least there, they'll bring you free drinks while you lose your money. Thank you so much for joining me to demystify the market in today's explainer. So after seeing the reality behind the screens, what kind of approach are you going to take with your money? See you next time.